Hello, everyone, and welcome to this session on a very topical issue of data challenges and solutions. I will be your moderator over the next 45 minutes. My name is Marianne. I'm leading out nature-related finance at Global Canopy and also supporting the TNFD Secretariat. So multiple studies show us that data and the lack of investor-ready data is one of the biggest barriers to aligning capital flows to net zero pathways and to the needs of nature. For instance, a Credit Suisse study showed us that 70% of investors, they see data as the biggest hurdle for them to make nature-aligned capital allocations. And now we have, on top of that, a regulation, so taxonomies plus 40 arriving around the world, that are adding additional data requirements to financial service institutions, including banks, investment managers, and asset owners, that data at the corporate level around corporate behavior in relation to green finance, it's no longer enough. You also need to have data that's investor ready at economic activity level and even at asset level. So this is what we're going to explore today. We're going to double click on the data challenge. How does it look like? More from an academic, but also from a practitioner perspective. And we have a world-class panel with us today to explore this. First, we have Truman Semans. He's the CEO of OS Climate. And OS Climate is part of the Linux Foundation. It is a breakthrough open solution for climate-aligned finance, investing, and financial regulation data. Previously, Truman was the CEO of Element Capital Advisors, helping family offices and foundations integrate climate and ESG into their portfolios. He also has an MBA and a BA from Duke University. We also have with us Andreas Hoepner. He's professor at Operational Risk Banking and Finance at the University College of Dublin. And he has also served as part of the head of the data subgroup on the European Union's platform for sustainable finance. So Andreas will be able to enlighten us much more on data readiness for the taxonomy and what's to come at the regulatory level. Then we have Bradley Foster with us today. He's the Global Head of Enterprise and Content at Bloomberg. He joined Bloomberg in June 2017 and manages the data content group within enterprise data. Brad focused on transforming how financial firms consume and use data by providing the most comprehensive, high quality, and complete enterprise content offering to customers. Lastly, we have Ellen Moeller. She's head of Europe at Watershed. She is head of Europe, and prior to joining Watershed, she spent a decade scaling technology business, including more than 6 years leading partnerships and operations at Stripe out of London. And prior to that, Ellen has worked in business development at a number of firms, including Visa. So let's start the conversation with you, Bradley, sitting really at the heart of the data supply to the market. What are some of the critical elements that should be considered to make sure that global sustainability data is available and ready and investor ready?
Thank you, Marianne, and thanks for having me on this panel. I think, when I think about this problem, I think about it in not just the context of the sustainability and ESG problem challenge that we're trying to address. I mean, we typically think about this as an enterprise solution, common with many other challenges that our clients are trying to address. And if you think about some of the common challenges, our clients need consistency, they need reliability, they need completeness, they need high quality data. They need that data in a way that they can easily consume and they can feed it into their enterprise systems. And it could be for anything from an investment use case to a risk management use case, or even the use case we're talking about today, which is around ESG and climate risk and related data. I think first off, what people need to understand is that without a proper data management strategy, this is going to be a really difficult problem to solve. I think, understanding what data management actually means, what it means once that data comes into your firm, how you normalize that data, how you build consistent identifiers across different data sets, is really, really important. So therefore, I see this very much as, step one, define your data management strategy, understand what that is. The other thing that I think is important to understand is that the many challenges that our clients and the market in general is trying to solve in this space involves much more than just ESG and sustainability data. The ability to actually take that data and link it with other data sets is incredibly important. If you think about things like transition risk, understanding company fundamentals, understanding how company transition to net zero is going to impact company fundamentals, understanding company supply chains, understanding in the context of physical risk, and having access to geolocation data is really, really important. And so making sure that you have a common symbology, making sure that you build interoperability between your different data sets is really, really critical. I think the other thing we need better, reported data. I think a very well-known challenge in this space is, there's a lack of framework, there's a lack of clarity, there's therefore a lack of company reported data. And so in the absence of reported data, really what you're asking the market to do is come up with an estimate. And so if you think about carbon emissions data as an example, we cover, circa 14,000 companies that report, but very few of those companies actually report their carbon emissions data. And even the companies that do report completely inconsistently. And so absent a framework and some outline as to how companies should be reporting and being really prescriptive in terms of what they report, I think is really a big challenge for the market. And because of that, you have extremely patchy data. And so I think, in our experience, what we see many of our clients having to therefore adopt a multi-vendor approach to solving this problem, because there's really no single source of truth for this data. And so the moment you do that, you introduce, a lot of other challenges in terms of bringing those different disparate data sets together from different vendors, normalizing that data, building common identifiers between that data so that you can actually link that data, becomes a really big challenge. And so I think in aggregate, many of the challenges that we're dealing with in this space are actually challenges that we've addressed and we've had to look at, even in the context of regulation. I mean, providing data to solve regulatory and compliance use cases is nothing new for Bloomberg. We've been doing this for years, both across the buy side, sell side. And so when you think about, SFDR and EU taxonomy, it's first and foremost a data challenge. And so, solving these problems where data is central to the solution is something that the market has dealt with in the past. We just now need to figure out how we tailor make that for the current problem that we're trying to address.
Thank you so much, Brad. And let me just throw that question on to continue those reflections on what does the data gap look like to Truman. You're heading up a platform which is trying to address some of the issues that Brad also highlighted today. Can you share a bit with us on the main data sets that are sitting on the OS Climate platform and why it's important to help investors in their climate transition?
Yes, and thanks very much, Marianne. And Bradley, actually, you stated the problem extremely well there. Interoperability is really crucial here. And, at the end of the day, also trust. I mean, Bradley, you sort of got at this. Ultimately, the capital is not going to move out of where it's creating the problem into solutions unless it is going to pass the tests of investment committees, credit committees, and the like. And so as you get further into small and mid cap, further into the global south, further into less covered sectors, you have increasing problems there. Open source climate, OS Climate, is for example, trying to address the multi-vendor problem that Bradley talked about by using essentially developing an architecture, an open architecture developed by Red Hat of moving toward a cascade of multiple sources, working as much as possible with public sources to address some of these problems. One of the ways that, for example, we're operationalizing that is S&P Global has contributed the largest global repository of CSR reports that do have the problems of patchy reporting and inaccurate reporting that the whole space is dealing with. But working on top of that, not only training data extraction with a wide range of partners to do that, but combining that or getting ready to combine that with Earth observation data with other sources to address that problem. I think, before turning it back to you, Marianne, also I'd note that come back to the data management problem that Bradley surfaced. It's crucial there, and there are many dimensions of it. One of the things that we're trying to tackle in the OS climate solution is the ability to have, again, for trust purposes, to have full transparency of all of the metadata from the reported source and how it's transformed all the way through to the point of use by the portfolio manager, by the credit manager, by the regulator, and to do that in an open and transparent manner, which we think is crucial. And also, and this is getting a little bit down in the weeds, but the weeds are important in these issues. The ability to time travel. So let's say you have a restatement, and we're going to see a lot of restatements, right, of what the actual footprint is. Large, sometimes very dramatic restatements by a corporate. Then that needs to flow through the whole chain to the point of use for strategic asset allocation, any of the various use cases. And so being able to time travel essentially is one of the really important data management challenges that OS Climate is working on. Last point there is, I think it's important to draw the distinction between upstream, the footprint data, and then the derived data that come out of tools like the ones that we're developing for physical risk and resilience, for alignment using first the ITR, implied temperature rise methodology, and transition analysis. So maybe we can get back to that later in the panel.
Excellent. Thank you so much, Truman. And I now want to turn the question to Ellen and explore with you how at Watershed you are working on exactly these data challenges. For as we heard with Truman, some of them are around scope 3 or they are around specific transition and physical risk. Over to you, Ellen.
Yeah, thank you, Marianne. And, just building maybe on what Bradley and Truman were saying, and I think, Truman, you put this well, there's sort of this upstream data that's going to be required to do all the things investors need to be able to do with that data. And that's really where Watershed comes in. So we are working directly with corporates to actually pull from their in-company primary data to then help them get the full picture of their emissions and actually go through that measurement process with them, which ultimately leads to them being able to make smart decisions on reductions, and then ultimately obviously report that out either to the market or to investors, et cetera, as well. And we also work with asset managers often with their portfolios, because what we hear is there's this big challenge, I think, as was described by Truman and Bradley, on kind of getting this data, especially from the private sector. And that's really where Watershed comes in, is kind of helping companies bottoms up actually build that picture that they can then report out on. And then ultimately that's kind of what ends up being critical for the decisions that they make as a business, either on target setting or on reductions, et cetera, as well.
And what types of technologies, Ellen, are you leveraging to get that data? Is that completely disclosed data from the companies, or are you also using Earth observation, other types of data sets?
We are trying to pull from where that data is sort of at its most primary form within an organization. So that means if they have systems of record already within the company, we will pull from that directly. We can integrate into systems that they already have. We can plug in with Teams if that's living in spreadsheets. They can send us data via API. So it's very flexible in terms of how we get the data. And then our software and technology and the services on top of that then applies the GHG accounting protocol to then measure emissions based on the data that we receive from those companies. Okay, and all of that is done in a way that is auditable and fully transparent in terms of what is being applied. I think, Truman, to your point earlier on being able to actually point back to where this data came from, we see that as very critical. So pointing that all back to the source, and then audit logs for what changes over time in terms of methodologies, emissions factors, et cetera.
Excellent. Thank you, Ellen. And I want to turn to Andreas, because you said a key word around auditability, and that's definitely something also at the regulatory level they are looking quite a lot into with with that entering into disclosure requirements in terms of how much are you modeling, how much are you measuring, etc. So the market also get that information of exactly the traceability of the data chain. But for you, Andreas, you have excellent insights into to the EU regulatory level. And can you share with us what you think from these new bodies of regulation, SFDR, taxonomy, etc., which are some of the core data challenges that these have introduced into the European markets?
Yeah, thank you very much for having me. Incidentally, I even speak from Brussels. The background is live here. So the challenge is quite simple. Most companies have significant disincentives to accurately report what in most cases constitutes pollution. So either they do not report or they underreport. Bloomberg has a very good data point on this, ES073 on greenhouse gas. It's the only one in the industry to my notes, so I'm not trying to give a shout out here to Bloomberg specifically, but that data point will give you a sense of how much underreported most of the greenhouse gas emissions are. So that leads to a significant problem, because given that a lot of firms do not report and outside the European Union may never report, I mean, CSRD will make about 50K European firms report and the European entities of international firms, so that's great. And they might give Ellen and others a lot of business. But at the same time, we need to consider that investors obviously need data from firms all over the world. And so there are non-reporters. So these non-reporters have to be estimated. But if you estimate the non-reporters in a standard way, then you estimate them too low, because you estimate them based on a lot of under-reporters, right? A lot of under-reporters seen as full, and they'll be estimated too low. So the taxonomy, SFDR, the benchmarks in particular, very much require you to follow the precautionary principle, which means that if in doubt, you err on the side of the planet, not on the side of commerce or company, which means the estimation for those that underreport has to be a good bit higher so that they're overestimated. So there's an incentive to then start reporting, which would hopefully make them look better. The estimation for those that underreport still has to be higher, maybe not as much as those that do not report, but it's very important that the estimation approaches follow the precautionary principle. It goes throughout the legislation. Realistically, we'll never solve this without estimating numbers for those that do not report that will incentivize them to start reporting. And you're not incentivized to someone else does all the work for you at a lot of cost with lower numbers, right? So if an estimation of a high-profile source will be lower than the real number, they'll never go to Ellen and hire them or anyone else, because why would they? They're better off just letting the estimation go ahead. And so one key message on data, we do need estimation. It's inevitable. And we do need the precautionary principle to make sure that the incentives that the estimations are generating will lead to more reporting and not to less reporting. And I will just post a link to a 3-page explanation that myself and Yuri Gelli from the IPCC have written on this. Everybody is very welcome to actually look into that.
And how have you how do you know that the estimations are under? How have you come to this conclusion that those that estimate are underestimating, not disclosing?
I'm very happy to explain that in 2 points. So first of all, if you take every data that's reported, we do know, Bloomberg would be one way of looking at it, that a lot of them are underreported. That also is practically simply the case because companies can't measure all their emissions. So to actually collect all the data in practice is really, really hard. Some of them are very honest. Deutsche Bank, not known necessarily to stand very well this year on the topic, but they have a report where they honestly admit we collected 65% of our carbon data and we estimate the remainder was ISO 14000, right? So some companies are very honest in the footnotes about how many percent they could collect, how many percent they don't. Bloomberg then puts that into ES074 or 3, which one of the two, and then tells you how much they underreport. So that means that every standard estimation approach, which takes the existing data, will underestimate because it is based on information which in most cases is too low. So you then have to essentially use the precautionary principle to overestimate, and you test this by using your estimation approach on the real data. And essentially the certainty that you get is if 90 or 95% of the real data is somewhat overestimated, then your estimation approach is good because you'll create incentives for the companies to start reporting better. Mm-hmm. The other way around is disastrous. You have a company that hasn't yet started reporting, which means board and top management isn't really into climate change mitigation too much. They're considering to start reporting. The environmental manager says, I'll need that much money to report, and it will be really hard to get all the data. And someone is going to say, well, but these guys estimate for us, and the number that they get is much lower than what we would get after we give you all the money. So why would we give you all the money and budget to actually start reporting? So it's absolutely important to see the interrelations between estimation and reporting, and the estimates need to incentivize the reporting and not, as they currently sadly do in the vast majority of cases, actually disincentivize better reporting.
Thank you so much for bringing this to the forefront, Andreas. And I think you highlighted Bloomberg quite a number of times on exactly this data point. So very interesting to bring it back to you, Bradley, really to reflect a bit on what you heard Andreas say in terms of how are you working exactly with this, and also thinking more about, now we talked about the European context, but as Bloomberg, you're a data provider globally on assets, right? So what are some of the cross-cutting dimensions in terms of data challenges that you see also outside of the European Union?
Yeah, so I think, well, a couple of things. Firstly, when it comes to carbon emissions data, this is a really difficult problem to solve, right? I think, the preferred option would be for everyone to report, and for everyone to report consistently and within a prescribed framework, because, absent that, not only are you either underestimating or at some level incorrectly determining what the carbon footprint of a company is, but you also, you've almost removed the ability to do any type of cross-company comparison. And so within an industry sector, it's very difficult to know one company to the next, how well do they perform, right? Cross sectors, it's really difficult to know. Therefore, when aggregated up to a sector level, how does one sector compare to another sector? And so, and the problem gets even more difficult when you move away from sort of scope 1 data and you move into sort of scope 2, and certainly for scope 3. And so, one way that we've approached this is that, in addition to what Andreas mentioned, is we've essentially built a greenhouse gas carbon emissions model, which essentially estimates the carbon footprint of a company. And it does this for 100,000 companies globally. And what it essentially, ultimately, it's a machine learning model that takes more than 600 features into the model, and essentially for scope 1 and 2 emissions data estimates what is the carbon footprint of the company. We do obviously backtest that model. We look at it relative to what companies actually report. And I think that, and obviously when you get to scope 3, you have to take a slightly different approach. You're having to cohort companies by industry sectors in terms, to try to come up with some type of estimate. But I'll tell you that the problem becomes even more acute when you get into the financial services sector. In terms of trying to estimate what is, for instance, the carbon footprint of whether it's Deutsche Bank or it's a US bank or an Asian bank, whatever that bank is. And I think part of the challenge that they face is that they have really complex balance sheets. They have really complex trading books. They have, if you think about it really simplistically, between banking book and trading book, a trading book is traders holding inventory to make markets for their clients. A banking book is a bank extending its balance sheet to borrowers. Those borrowers have suppliers, therefore they have a supply chain. And in terms of trying to determine what is the carbon footprint of a bank, you have to take all those factors into consideration. And it's not an easy, you can imagine how many dimensions of data you're talking about. You're talking about, oftentimes a balance sheet that's moving around quite a lot, especially in the context of trading book. And so, yeah, as I say, we've approached this problem from a very, through, somewhat simple lens. We have ESG reported data. We provide that data to our customers. We provide ESG scores to our customers. Those scores are based on company reported data. We provide full transparency into those scores. But what we also need to provide to our customers as they deal with this world of decarbonization and transition to net zero, as I said earlier, in the absence of an actual reported data, is some type of estimate. We don't say that a company A has a carbon footprint of a single number. We actually provide a full distribution, so from a 25th to a 99th percentile. So you can choose, in the spirit of precautionary principles, to be really conservative. As an example, with the Paris-Aligned benchmarks, some of this data feeds into the Bloomberg Paris-aligned benchmarks, and there they are conservative. So the 75th percentile would be used, and so and what we also provide is we provide a score against that distribution, which gives our clients an indication of how good or how quality the data is going into determining that distribution. So obviously a low score, you would probably want to be more conservative. If we were able to apply a really high score, we had high confidence in terms of the data going into determining that distribution, you might choose a different percentile. But we're not telling our customers, this is the number, go forth and use it. We're providing a distribution. It's very clear that it's an estimate, and it's, obviously as we get more data, as we do feature enhancements, as we continue to backtest the model, that will hopefully over time become more accurate. But the real hope is that ultimately the requirement for estimates is gone, and that companies actually report, and that as an industry, that data is available to everyone. I mean, if you look at the net zero data public utility, which is essentially trying to make, democratize some of this data, make it available to everyone, and I'm talking about carbon emissions data targets, etc. That would be the preferred outcome, is that we have access to that data and we can provide that to everyone in the market. And I think, short of that, we really have to be a little creative in terms of how we create estimates that people can start to work with.
Thank you so much, Bradley, both for highlighting data needs to be available, but it also needs to be up to quality, and that you actually enables the market to assess also that quality in disclosed or in your company offerings. And that brings me to you, Truman, because also when Bradley mentioned this Net Zero Data Alliance, because that's a way to democratize, as he said, data. But your platform, OS Climate, is also an innovative platform to try to tackle some of these challenges. So what is OS Climate's role as you see it going into the future, tackling some of this market demand of having more measured data, more high quality data, etc.?
So a couple of things there. So first, in case the audience isn't familiar with OS Climate or how it works, or the big the main breakthrough there is applying the very mature approach of community-based open source development that has been completely transformative in the tech sectors, and also fortunately in the life sciences sectors, for example, in vaccine development, to these challenges around data and analytics, and closing those gaps. And so one way of thinking about it is that it's a co-op where users and providers around a group of problems roll up their sleeves and put in developers, data scientists, and the like to jointly solve these problems. And in the case of OS Climate, that involves users like Goldman and BNP Paribas, Allianz. The Net Zero Asset Owner Alliance as a whole is a member of this community, and then providers like Microsoft, Amazon, and LSEG and S&P working together to tackle some of these problems. In terms of the sort of the frameworks, I think it's important to note that we're basically at service. We're a nonprofit that has developed already key elements of a public utility, and working very closely with Bradley's colleagues and the people that are over in the development of the net zero public utility. And on the advisory group for that effort, and the steering committee announced in June by Macron and Bloomberg. It's a very crowded space around these things, and a lot of sort of nested initiatives. So sort of getting to another part of your question there. It's going to be fundamentally important for a joint and collaboration that is very open and transparent. So one of the things that is crucial here is non-aligned entities, right? So there, and I think this is the some of the promise for initiatives like OS Climate to work together with commercial initiatives like Bloomberg and the Net Zero Public Utility, and being non-aligned, non-profit, and essentially not a commercial entity, providing key elements of a data utility that then. And this is another key aspect of the way Linux Foundation open source projects work, where entities such as Bloomberg, such as other data and analytics providers, such as Watershed, for example, can take the public good that is created by OS Climate, whether on the data commons side or in these analytic tools, and then incorporate them into their platform, or feed, in the case of Watershed, for example, feed data in and then provide specialized client services on top. So it's a technology accelerator and solution accelerator, as you will, where that open source collaboration can reduce the cost of developing solutions, increase the speed, and increase the quality through the learning that occurs when you have a wide range, not only of asset owners, asset managers, and banks collaborating, but also key university partners, key partners in the public sphere, the potentially, in our case, looking forward to collaborate with the Med Office, and with associations like GFMA, et cetera.
Thank you so much, Truman. And I think he already sort of threw the question back to you, Ellen, in terms of how are you at Watershed looking to the future in terms of leveraging some of these open source data sets from OS Climate and other sort of public utility source data to really improve your data offering?
I mean, I'll say from our end, we want to be pulling in data where relevant to the organizations that we work with that can help get them. I think you mentioned sort of cost, speed, and accuracy, Truman. That's kind of the holy grail of what we want to kind of help companies get to a picture that achieves those pieces. I maybe want to kind of double click actually what on Bradley was sharing on kind of the challenges around scope 3 as well, because we certainly see that. And a lot of the focus for Watershed and working with our customers is on scope 3. And I completely agree with you about it. There's a space for estimates that are just necessary as it relates to kind of scope 3 and the way that we think about analysis there. But I also think that's actually where, and to Andreas' point of that often being kind of, if we lean into that being overestimated, that can become very powerful, because some of this network effect that we see with the corporates we work with is if they're actually having to measure their scope 3, if they're required to do so, either because investors are asking or because of CSRD or because of other reasons, they're going to care about the emissions within their supply chain. And if those are overestimated, it really puts the impetus then on the corporate to engage that supply chain and get them to report. And it's that kind of ecosystem effect that we're starting to see with the corporates we work with. And that actually is quite exciting, because they're actually pushing their suppliers, people who want the money that they give them in their relationships. And so money kind of talks here to actually get them to then go on their own side and start reporting with greater clarity, with greater rigor, et cetera, such that they're not relying on estimates. And so I think there's this sort of interesting balance right now on estimates being overestimated, as you say, Andreas, to actually not even just in the kind of financial sector, but even within corporates, enable that level of engagement that hopefully leads to, again, that holy grail of everyone reporting and everyone reporting in a unified framework.
Thank you, Ellen. And you even started to touch upon answering one of the questions that are coming in from the audience in terms of how does, if it really adversely affect your bottom line, how does that sort of incentivize new types of better estimates to the market? So thank you so much for that. We have a number of questions that come in. Let me read one out. I think could go well to you, Andreas, actually. It says, what are thoughts on the quality of estimating carbon footprint on tools such as the joint impact model? Would harmonizing the approach across industry at least create a comparable foundation for targeting the next steps? Would you reflect on that with us, Andreas?
Yeah, happy to do that. So as Ellen just said, I mean, the legislation is for investors to companies, but of course, companies are very much investors in their suppliers. And so if companies look at their supply chain, they may want to use the precautionary principle, of course, as well. That's very much equivalently applicable. I think what we need to understand is for any estimate or data, it is, from an investor perspective, important to be reliable financially independent, so that they have a financially independent way of looking at it and thereby not potentially biased. And some deviation or differentiation is actually useful because you have different providers providing different estimates. So standardization is a theoretical and somewhat oversimplistic ambition here. On the estimate side, you won't get that. You should, of course, have standardization on the reported side. Now, the second biggest challenge in data is that that is not the case. So if you today go to a range of different vendors and you look at the data that they provide you for Scope 1 greenhouse gas emissions or for Scope 2 market-based emissions, and you compare them, you will find out the vendors don't actually provide you the same number in quite a few cases. And if you then compare them with the number on the website, you find out they don't provide you the number that's currently the most live on the website. And that is the second big challenge, apart from the estimation, is live. Most climate data is far from live. Most climate data is whenever the vendor looked last. And that can be between 8 to 18, sometimes 24 months ago. So in that sense, we do need, in particular for Paris-aligned benchmarks, which require a reduction of 7% year on year, we need to get to much more live state in the data, meaning that as soon as a company puts a new number out, and as soon, I mean at least within weeks, not necessarily days, but within weeks, that number should be reflected by the vast majority of solid vendors. It shouldn't be the case that quite a few vendors will need several months, sometimes over a year, to actually reflect the new numbers from the companies. And that's quite an important way of rethinking at the vendor level, because right now most of the vendors focus on the report. Of course, the report comes only out once a year, so to an extent you can try to time that with your analyst. But a lot of the relevant information nowadays, the companies are updating on the websites any day of the year, pretty much, at least any weekday of the year. So for instance, your net zero target might be shifted a tiny bit here and there. Your Scope 3 estimation assumptions might be shifted. Your whole approach might be shifted. And
but so how to incentivize that, Andreas?
Incentivize for whom? For the vendors?
For the corporates to disclose at a higher frequency.
The corporates are actually disclosing a higher frequency. The precaution principle, of course, incentivizes them to disclose in general. And then those corporates that are disclosing at a higher frequency because they're trying to make progress. If you're a corporate and you're only making progress once a year nowadays, that's not necessarily leading in your industry on climate. Many corporates will try to have news items 3, 4, 5 times a year, disclosure being one of them. So actually the data, as one would see it from a financial data science perspective, already points to the companies disclosing more than once a year and disclosing not only through like PDF reports, but also disclosing through any other update on your website, as anyone may update their own profiles on LinkedIn or something more often than once a year.
Can I make a comment on that just
quickly? Of course.
So I think if you believe that as companies start to transition, or not start, but most companies have started that journey to net zero, is going to have an impact on company performance, company fundamentals. If you have to change your business model, clearly that could come with a revenue impact. It may come with a cost impact. Companies that do poorly when it comes to transitioning to net zero may be precluded from Article 8 and 9 funds actually holding their debt, for example. And so therefore you have to believe that could have an impact on credit spreads, and it could have an impact on a company's ability to fund itself in the capital market. So there are very many knock-on effects. And if you believe that all of the above is true, and I think most people would agree with that, then I think what would be really helpful, in addition to creating a framework that gets companies to report consistently, is to get into a cadence like you have for company fiscal reporting, where they are, as part of their income statement and balance sheet and cash flows and ratios, that they report, and they've been doing for years, in line with US GAAP and whatever accounting standards that they provide their fundamentals data. If they got into the same cadence where they reported their ESG data, including carbon data, in line with their fundamentals, I think that would be a major step forward. If I look at how, because fundamentals data has been around for so long, we are extremely timely in terms of when we report that data. So when a company reports its earnings, that data gets reported extremely quickly. And I think if we got to that point and we were able to have ESG data, including carbon data, reported alongside company financials data, I think we would, that would go a long way to address some of the challenges that we're talking about here.
Excellent. Thank you so much, Bradley. Hold it, Andreas. Thank you so much for also formulating a future vision that we need to get carbon emissions data, etc., into balance sheets and financial statements. So I think we have a very clear road ahead of us. I want to just, in the interest of time, we have 5 minutes left. It's running really quickly in such a great conversation. I want to give all of you a closing statement. And reflecting on, now I have the pleasure to work with the Task Force for Nature-Related Financial Disclosures. So that's sort of the next green data layer that we are going all to work on. So really reflecting on what's around the corner in terms of the data models and data offerings you have today, and how can some of that learning help us to create also helpful investor-ready data for the nature-related financial risk agenda. So please take 1 minute each. Then we are at the finish line to reflect on that. Who wants to go first? You want Ellen or Andreas? Andreas, you've been waiting. Go ahead.
Go ahead.
So I challenge companies one step further than Bradley. Most of the environmental data is not as competition relevant. You can take your sensors and make them live on the internet. Like, it can be much faster than climate data. And I've discussed with some companies who are willing to consider, at least for the better factories, to take the sensors and make the actual pollution live for everybody visible, basically real time. For financial data, you'll never do it because of competitive aspects and so forth. But with the environmental data, it's not that competition relevant. You could actually do it. To come to the actual question in 30 seconds, the key thing for biodiversity in particular to get to is the one beautiful thing that makes climate change mitigation work. And every Article 9.3 fund has to reduce emissions 7% year on year, or at least compete with the benchmark, which does. And that's the E in the CO2E. The E in the CO2 is one level of standardization that globally works. And what biodiversity needs to come up with is that E, the equivalent between species lost across the planet, between Brazil and Indonesia, between Democratic Republic of Congo and maybe Sweden for that matter. And that E needs to be developed and agreed upon globally. With that E, we can then use quite similar frameworks as we have Paris-line benchmarks, for instance, on climate, and it will work quite well. But without that E, it'll be a collection of ideas, a collection of narratives.
Thank you,
but
Andreas.
It won't be measurable and scalable. Yeah.
Wonderful. Thank you for that focus on the E. Ellen, 30 seconds for you.
Yes, happy to. Thank you. So I'll just come back to, I think this concept that Bradley and Andreas are describing on much more frequent reporting on emissions is going to be so critical. The challenge is we cannot forget that the last sort of 10 years, this has largely been done in spreadsheets in a corner of companies. And that is never going to get us to the case where they can actually be reporting on a quarterly basis, let alone on a kind of, if you think about doing this on a much more frequent, Andreas, as you describe. And so I think we need a lot more investment in the tools for companies to do this, to reduce that barrier of entry, make it easier to data collect, and then ultimately able to report. And that's a lot of obviously what we think about. And then that, we want to get to a point where this is looked at truly with the same level of rigor as financial metrics are for organizations, because only then is that going to get brought into business practices throughout a company and held to a standard that's going to actually enact change.
Excellent. Very clearly put. Thank you. Over to you, Truman.
Thanks. Couple of things here. One is the architecture and infrastructure that has been built for our data commons and the way that it connects with tools are developed in a way that as greater clarity around metrics come in under TNFD and others, that can be extended into and put to purposeful use for addressing these issues. And we work closely with advisors like Margaret Kulo at WWF and many others to do this and actively engaging in that area. In the near term, though, there's not a hard line between in a lot of ways, what's happening around mitigation and physical risk for climate and nature-based solutions and biodiversity. So, for example, the work that's being led by BNP Paribas out of London by Matt Sandow and his team around the fiscal risk and resilience tool that we're developing, that open tool that is looking right now at vulnerability assessments that are associated with a range of different flood, heat, fire, and risk. But we'll be looking at impacts that are actually geolocated. So there'll be the potential to look at biodiversity impacts as well.
Thank you so much, Truman. And 30 seconds for you, Bradley, for your closing remarks.
I mean, I'd maybe just recap a couple of things I started off with. I understand that aside from the patchiness of the data and getting companies to report, etc., I think understand that this is first and foremost a data management problem. So define your data management strategy, understand what interoperability of data actually means, because unless you build that interoperability, combining this ESG or company reported data with things like supply chain data, geolocation data, company fundamentals data is going to be a really difficult problem to solve.
Thank you so much, everyone, for enlightening us. And we hope Montreal in December will give us the E for nature, the species at risk type metric that we can all start to work on and use all of your platforms to build on that additional data layer. Thank you so much for joining us and for enlightening us.
Thank you, Maria.
Thank you.
Thank you.
Thank you.